So, the numbers are in for Republic Services. And you probably saw the headlines, right? They screamed beat. But then you look at the stock chart, and it took a hit. So what gives? Wall Street clearly saw one thing, the company's press release said another, and investors like you were just left scratching their heads. Today on Iron Financial, we are going to forge right through all that noise and find out why. We're going to break this whole report down piece by piece, hammer out the facts, and deliver a clear verdict. Is this really a foundational, bedrock company you can build a portfolio on, or is it just a high-price structure with some hidden cracks? All right, let's get to work.
Welcome to Iron Financial. This is the one place where we help you forge a stronger portfolio by cutting straight through the market's weakness. I'm your lead analyst. I'm the one who lives and breathes the numbers, the revenue, the debt, the margins, the whole shebang. And across from me, well, he's our market skeptic. His job is to represent you, the investor. He asks the tough questions, he keeps me honest, and he makes absolutely sure we separate the real, hard data from the hype. Our mission here is simple. We give you the unvarnished, data-driven truth so you can make smarter, more confident decisions with your capital.
Okay, let's dive right into this. Here's our blueprint for today. First up, we're going to set the stage with the current market conditions. I mean, you can't really evaluate a building without knowing the ground it's built on, right? Then we are going to build the bull case for Republic Services, brick by solid brick, using their own reported numbers. After that, I'm turning it over to our skeptic to stress test that foundation for any weaknesses. From there, we'll dig into the company's own blueprint for future growth. And finally, the part you're waiting for. We will deliver the official Iron Financial verdict.
Look, before we put any single stock under the microscope, we have to understand the environment it's operating in. And right now, let's be honest, the market is a total mess of contradictions. It's sending all these mixed signals, which makes it a complete minefield for investors. You've got these incredibly powerful economic forces pushing in opposite directions. And if you don't get a handle on these crosswinds, you're basically flying blind. It's just not enough to know if a company is strong. You've got to know if it's strong enough to weather the coming storm.
Now, what's really fascinating about what you're seeing here is the massive disconnect it shows. It's a real head-scratcher, isn't it? I mean, look at the left side. You've got these powerful economic tailwinds pushing us forward. The January CPI report came in a little softer than people expected, showing that this disinflation trend is legit. Then the jobs report just blew past expectations, with really strong hiring. Cooling inflation and a booming labor market, I mean, that's the textbook definition of a perfect soft landing. But then you glance over at the right side of the slide, and the market is screaming the exact opposite. The S&P 500 was down almost a full percentage point in that same week. We saw a really nasty, concentrated sell-off in key sectors like financials and software. So the core economy looks solid as a rock, but the stock market is nervous. It's skittish. This is the exact environment Republic Services reported into, one where even good news isn't necessarily being rewarded.
All right, enough about all that broad market noise. Let's drill down into the steel frame of Republic Services' 2025 performance. Look, the market can be irrational, but numbers, especially numbers pulled directly from SEC filings, they don't lie. We're going to look at the revenue, the profits, and, most importantly, the cash. This is the foundation of the company, and from where I'm sitting, it looks incredibly solid.
Let's start right at the top line. Just look at that number on your screen, $16.59 billion. That's B with a billion in revenue for the full year. That's up a solid 3.5% from the year before. You know, in a world where these high-flying tech companies are getting hammered, this kind of steady, reliable growth from an absolutely essential service, I mean, everyone needs their trash collected, is a beacon of stability. This isn't just a number, it's proof of a resilient business model that works no matter which way those market crosswinds are blowing.
Now let's move from what they made to what they kept, because this is where the story gets even stronger. $5.31 billion in adjusted EBITDA. Now, for those of you who aren't familiar, EBITDA is a pretty clean measure of a company's pure operating performance. Just think of it as the cash the business is generating before you start accounting for things like interest payments and taxes. And it's not just that they made more money, they got more efficient at doing it. Their profit margin expanded by 90 basis points to 32%. So what does that mean? It means for every single dollar of revenue that came in the door, more of it was converted directly into pure profit. That, my friends, is the mark of a disciplined, effective management team.
So the crucial point is this number right here. To me, this is it. This is the ultimate measure of a company's financial strength.
Adjusted free cash flow of $2.43 billion. This is the pure cash left over after they've paid for everything, and I mean everything required to run and maintain the business. This is the cash they can use to go out and build the business, to make acquisitions, and to reward shareholders directly. And just look at that growth on your screen. It's up a powerful 11.5% from 2024. A company that is gushing this much cash isn't just surviving, it's thriving. It has options, it has power.
Let's move to this slide, and you can see how this all builds on itself. This table, it just reinforces that story of strength across the board. Look at the consistency here. Adjusted earnings per share up almost 9%. Cash from operations up over 9%. Net income up almost 5%. There are no weak spots here, you see? Every single key metric is moving in the right direction. It demonstrates strong, steady, predictable execution. This isn't some one-hit wonder quarter. This is a full-year story of a well-oiled machine just firing on all cylinders.
And you know what? You don't have to take my word for it. John Vander Ark, the CEO, he said it himself. We delivered another strong year, underscoring the resilience of our business model. That word right there, resilience, that's the key. He also went on to highlight that they exceeded their own internal expectations for both adjusted EPS and free cash flow. So think about that. This isn't just a company meeting its goals, it's a company smashing them. Management told the world what they were going to do, and then they went out and over-delivered. That builds a ton of credibility.
And this, well, this just brilliantly illustrates what a company does when it's flush with cash and super confident in its future. They give it back to the owners, the shareholders. A whopping $1.6 billion returned directly to shareholders in 2025 alone. That breaks down into $854 million in share buybacks, which makes every remaining share more valuable, and $738 million in cold, hard cash dividends paid right into their accounts. That's a company putting its money where its mouth is. This is the ultimate signal of management's confidence in the stability and, more importantly, the future growth of the business.
Whoa. Hold on. You're painting a very pretty picture, a very rosy picture, but you're conveniently ignoring the massive elephant in the room. All of this, everything you just said, it's in the rearview mirror. The stock market cares about tomorrow, not yesterday. So I have one simple question for you. If this financial fortress is so impenetrable, why did the stock fall after the announcement? The market obviously saw something it didn't like. Let's stop looking at yesterday's news and actually examine what Wall Street really saw.
This is the only question that matters. You can sit here and praise a company's past performance all day long, but the stock price, that reflects the collective judgment of millions of investors about the future, and on the day they announced these great numbers, that judgment was negative. The bull case we just heard, well, that's the story the company wants you to see. Now we're going to look at what the market actually saw.
Okay, this is it. This is where the rubber meets the road. This slide right here explains the entire negative reaction in the stock. Yes, they beat on fourth quarter earnings per share. That's the headline you saw, the one they blasted out. But look closer. They missed on revenue. They brought in $4.14 billion when the street was looking for $4.21 billion. That's the first crack in the foundation. But the bigger problem, the one that really tanked the stock, is the guidance for 2026. This is their forecast for the future, and it came in light. They guided to earnings per share of around $7.24 at the midpoint, when the analyst consensus was up at $7.30, and they guided to revenue that was almost $200 million below what everyone was expecting at the midpoint. You see, the past is the past. The market always looks forward, and Republic Services just told the world that their growth in the year ahead will be less than what everyone was hoping for. That, right there, is why the stock went down. Period.
And here's the other side of that coin. For the privilege of owning this company with its slightly disappointing forward guidance, you're paying a very, very steep price. Look at that number, a price-to-earnings ratio of nearly 33. The PE ratio is basically a measure of how much investors are willing to pay today for each dollar of a company's earnings. A high PE means super high expectations. A PE this high implies investors are expecting absolutely explosive growth. But as we just saw, the company itself is signaling that its growth might actually be slowing down. Do you see the disconnect? So, the question is, and it's a big one, does a company with slowing growth expectations really deserve such a premium valuation? The market's initial reaction was a clear and resounding no. You can have a great company, a fortress as my colleague calls it, but if you overpay for it, it is still a bad investment. The bull case focuses on the quality of the asset. My case focuses on the price you have to pay. And right now, that price tag looks very, very high.
A premium price for a premium company. That's what you're missing here. You're laser-focused on a slight guidance miss, a few pennies below consensus, but you're completely ignoring the heavy lifting they're doing right now to build future growth that isn't even factored into that guidance yet.
The market is being incredibly short-sighted here. It's punishing the stock for a conservative forecast while completely ignoring the massive investments being made to forge a much bigger, more profitable company down the road.
Let's look at the actual blueprint for growth. That $2.4 billion in free cash flow, it's not just sitting in a bank account collecting dust. They are deploying it. They invested $1.1 billion in acquisitions in 2025, buying up smaller competitors to expand their footprint and gain incredible efficiencies of scale. And they've already said they plan to do it again, with another $1 billion earmarked for 2026. But it's not just about getting bigger, it's about getting smarter. They completed 9 renewable natural gas projects. Now, this isn't just some green initiative. This is about turning a waste product, landfill gas, into a valuable, high-margin revenue stream. It's a total win-win. And then there's the new Polymer Center in Indianapolis. This is a direct play on the circular economy, improving plastics recycling and meeting the massive demand from consumer product companies for recycled content. These are all investments in high-growth, sustainable business lines that are going to pay dividends for decades. The market is worried about next year's EPS. Management is busy building the company for the next 10 years.
So this is really where we disagree. I look at this slide and I see a company laying a solid foundation for future earnings that Wall Street models haven't even caught up to yet. These investments are planting the seeds of future growth.
Seeds of growth that are already reflected in the stock price. That PE of 33 is not for a slow and steady utility. That price already assumes this growth is going to happen and that it's going to be absolutely spectacular. The stock is priced for perfection.
But the market is missing the scale. $1 billion in acquisitions adds real, tangible revenue and EBITDA that flows straight to the bottom line. That's not speculation.
Okay, then why didn't they reflect that in their 2026 guidance? If these projects were going to create some massive earnings surprise, why was their own outlook so conservative?
Because they're a disciplined management team that has a history of under-promising and over-delivering. We just saw that in the 2025 results. They're building in a buffer. It's smart.
Or, and hear me out, their core business is slowing down more than you think, and these new investments are just trying to plug the gap. The market needs to see that investment translate into better than expected guidance to justify this price. Right now, there's a big disconnect.
Okay, so we've seen the solid foundation from the 2025 results. We've taken a hard look at the potential cracks that the market's reaction has identified. We've debated the growth plan. Now it's time to forge a verdict. Is Republic Services an opportunity, or is it a trap? So let's just summarize the entire argument right here. The foundation, the bull case, it's built on the undeniable facts of 2025. Rock-solid execution, expanding margins, a fire hose of free cash flow, and a clear, demonstrated commitment to shareholders. By all measures, this is a high-quality, well-run company. But the cracks are just as real. The slight miss on revenue, the underwhelming guidance for the year ahead, and the incredibly rich valuation you have to pay for the stock. This is the core conflict. You've got proven quality for some serious forward-looking concerns and a price tag that leaves absolutely no room for error.
The iron financial verdict is this. Republic Services is a fundamentally sound company. There is no question about that. It's a fortress built on strong cash flows, an essential business model, and smart, disciplined management. There is absolutely nothing wrong with the underlying business. The execution in 2025 was truly top tier, and the investments they are making position them very well for the long term. This is, without a doubt, a premium asset.
But, and this is a big but, a strong fortress at the wrong price is a trap. Don't fall into it. The market sent a clear signal with that price drop. It wasn't irrational. It was a repricing based on future expectations. The market is telling you loud and clear that the current price is too high for the growth the company itself is forecasting. Therefore, our final verdict is to exercise patience. This is a high-quality name for your watch list, not your buy list. Wait for a crack in the price, a market pullback, a sector rotation, any kind of broader weakness to build a position. A great company at a bad price is still a bad investment.
So at the end of the day, it all comes down to finding that perfect balance between a great company and a great price. Republic Services is the high-quality asset, no doubt, but the market is telling you the price just isn't right, at least not yet. So we want to know what you think. Let us know down in the comments. Is this a bedrock company you're willing to pay a premium for because you believe in that long-term growth story? Or are you siding with the market and waiting for a better price to come along? Don't forget to subscribe to Iron Financial as we continue our mission to forge stronger portfolios. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.